The general philosophy that you'll hear people say is, well, you can never get rid of tax debts in bankruptcy, but that's not entirely true. In bankruptcy, we make a distinction between what are called trust fund taxes and non-trust fund taxes. Trust fund taxes are never dischargeable in bankruptcy, and the quintessential example of a trust fund tax is a payroll tax. So what is a payroll tax? Well, when an employer has employees and pays them prior to giving the employee the paycheck, the employer is supposed to take out taxes and then send them to the taxing authority. We'll just generically refer to it as the IRS, although here in California, we do have the Franchise Tax Board, which is the state's taxing authority. Now, the employer then never owns that money. The employer holds it in trust for the IRS. And if the employer doesn't send the money to the IRS, it has breached that trust. And that kind of a debt can never be discharged. It's a violation of a sacred trust between the employer and the IRS. And in fact, that type of failure to pay tax can be a criminal action that can lead to imprisonment. So that's one type of tax debt that you can never get rid of, a trust fund tax. In the other realm, most of the taxes involved are income taxes rather than payroll taxes. In certain circumstances, income taxes can be discharged in bankruptcy. The general rule, and there are some exceptions, but let's start with the general setting, is that the tax debt, the income tax debt, has to satisfy all three requirements. And if you're off on even one of them, you lose. So the first requirement is generally referred to as the 3-year rule. What does that say? It says that if you're going to discharge tax for that given tax year, then the return for that given tax year must have been due, with extensions if you got them, at least 3 years before the day you file the bankruptcy petition. And it's even down to the day. If you're off by even 1 day, you lose. There is no mercy with the IRS. So that's the first requirement, the 3-year rule. The second requirement is the 2-year rule. Now, you may have noticed when I described the 3-year rule, I didn't actually say anything about whether you'd filed a return. I simply said when the return was due. The 2-year rule focuses on whether or not you filed the return. And here the requirement is that you must have filed a legitimate, non-fraudulent return for the given tax year at least 2 years before the day you file the bankruptcy petition. Once again, it's down to the day. If you file the bankruptcy papers even 1 day too soon, you lose. And then the third requirement is the 240-day rule. Now, the 240-day rule says that the tax you're trying to discharge cannot have been assessed or have been assessable during the 240-day window immediately prior to the day you file the bankruptcy papers. Now, since 8 times 3 is 24, 8 times 30 is 240. So this is 240 days, which is 8 30-day months. Now, you're not going to know when the tax was assessed without getting the tax transcript. And at least the IRS does make available account transcripts. There are different types of transcripts. This particular kind of transcript is called an account transcript, and it gives a chronological history for your Social Security number for that given tax year. And so you can go down to the last assessment, count 241 days later, and you'll be okay. Now, what exactly is assessment? Well, when you send in your income tax return, it goes to the IRS, and let's say you sent it in on time, April 15th, and the IRS processed it on April 15th, right? Not a chance. They're processing something on the order of 225 million tax returns every year from businesses, individuals, married couples. They're not going to get to your return right away. Maybe they get to your return on July 10th. And the person processing the return takes a look and says, oh, looks like you owe us some tax, and enters that into the IRS's computer system. That is the assessment. And then, of course, there can be later on assessed penalties and interest. And perhaps the IRS audits your return and assesses more later on. In any event, you go to the last assessment and count 241 days, and that will take care of that 240-day requirement. The account transcript also will have the date you filed the return, so you count 2 years after that. And sometimes you have to look it up to see when the return was due, because there are a couple of things at work. In some years, the return isn't due on April 15th. It might be April 16th or 17th because of certain holidays. On top of that, maybe you got an extension, and sometimes the IRS will give an extension without you requesting it. Let's say you were living in a disaster area and that area was declared a disaster area, and automatically you got an extension to file 3 months. So you're going to want to look into that first before you file the bankruptcy petition, because you don't want to file it too soon. Now, to add a couple of little wrinkles to all of this, there are some tolling statutes in the bankruptcy code. One is, if you were in an offer in compromise, then you might have gotten to 225 days on the 240-day clock. You enter the offer, the clock stops. And it stays stopped until the offer terminates, and then you add an additional 30 days. Again, if you're even 1 day off, you lose. Or you were in a prior bankruptcy case. You filed that bankruptcy case, that stopped the clock. And this also applies to the 3-year rule, the 2-year rule. You get to the end of the bankruptcy case, the case closes. Now with bankruptcy, you add 90 days before you file the bankruptcy papers. Plus, of course, letting the clock tick, because it's not just, well, the clock stopped, you went through the bankruptcy, then 90 days, and then you file. You also have to add the unused up portion of time prior to filing the bankruptcy case. So if you can satisfy these requirements, generally you'll be okay. Now there's yet another wrinkle. Sometimes if you don't get around to filing your return and the IRS is drumming its metaphorical fingers on the table, it'll finally say, you know, it doesn't look like you're going to be filing. We're going to file a tax return on your behalf. That kind of a tax return is called a substitute for return. And if the IRS files a substitute for return, that tax debt is never dischargeable. Certainly not in the Ninth Circuit where California is. Now, there is kind of an unusual patchwork here and there around the country. Perhaps the most draconian approach is in the Fifth Circuit, and that includes Texas, Mississippi. And there was a case in Mississippi a few years ago called the McCoy case, in which the Fifth Circuit held that if you file the return even 1 day late, it is not considered a return for bankruptcy discharge purposes. It may be a return for the taxing authority's purpose, but it's not a return for being able to discharge the debt in bankruptcy. So if you're in the Fifth Circuit, you'll never be able to discharge that tax year's tax debt because you filed late. And even 1 day late, it's not a return. Now, another approach is in the Sixth Circuit, one of the Midwest circuits. And they take the position, you can file the return late, but if the IRS files that substitute for return, then you never get rid of the tax debt. So that's sort of what I described a little bit ago. The nicest, most lenient circuit for this purpose is the Eighth Circuit, another Midwest circuit. And that circuit takes the position that you can file the return late even if the IRS files a substitute for return. You wait long enough and you can get rid of that tax debt in bankruptcy. The Ninth Circuit takes the position that if the IRS files a substitute for return, the tax is never dischargeable. The Ninth Circuit has never considered the question of whether a late filed return is not a return for bankruptcy purposes. Interestingly enough, even the IRS, we normally think of that as a very harsh agency, has taken the position that the McCoy rule is too draconian. And so they won't push it if you file a return late, as long as you have not had that substitute for return filed on your behalf. In any event, yes, you can get rid of tax debt under certain circumstances, but this is not for the novice. You really need to get in touch with a competent bankruptcy attorney who can do the analysis for you. Because if you get it wrong, you go through the bankruptcy and you emerge and you still have all that tax debt. So that's what I have to say about tax debt. And again, if you're looking to get rid of tax debt, you probably want to contact a competent bankruptcy attorney.